If I could use one word to describe the stock market over the last 6 months, that word would be volatility. And with the out of control inflation right now pushing the Federal Reserve towards potential rate hikes and asset tapering, I think we're going to see this trend continuing in 2022. Now, for just that reason alone, it's important now more than ever to have a strategy when it comes to investing in the stock market. There are countless stocks out there that are down 70, 80, or even 90% from their all-time highs. So shoveling money into the markets may have been a strategy that worked well over the last couple years. However, I really do not expect this to work well for most people in 2022. In order to both minimize your downside risk and keep your emotions under control, you have to have a clear and defined strategy to follow when it comes to investing. So in this video, I'm going to be covering some of the best stock market investing strategies that have worked well for others in the past. But do keep in mind, there's no one single strategy out there that works 100% of the time. If there was, every single person out there would follow and repeat that strategy, make millions of dollars, and retire. However, having a strategy when it comes to investing is still going to be a lot better than having no strategy at all. Real quick here, guys, before we get into the video, I just want to mention that I am not a financial advisor, and this video is not any sort of financial advice. You should always do your own due diligence and research above and beyond this video before investing. Also, this video is sponsored by a brand new investing app called Domain Money, but more on that later. That being said, let's jump into the very first strategy. So strategy number one is none other than dollar cost averaging. So if you were to look at the exact opposite of piling money into the market all at once, the opposite of that would be what we have here, which is dollar cost averaging. Now, here's the thing. When markets are only going up, a lot of people can get away with basically FOMOing into the market and piling money in. However, what we've seen so far, at least in the end of 2021 and beginning of 2022, is this is not the same stock market as it was in the last couple of years. The problem is when you pile money into the market, if things turn around the other direction, this could mean huge losses. Not to mention, if you put all of your money into the market at once, you're not going to have any money left over to buy additional shares. And that can be a really annoying and difficult situation for people because you might see a buying opportunity where, assets are selling off tremendously, but if you don't have any cash, you can't take advantage of any of those deals. Now, even though some people might not have more money that they want to put into a losing position, they might do it anyway just because they want to average down on their cost basis or lower their average price per share. But the problem is at that point, you might become under-diversified and you have too much exposure to one or a small handful of different companies. So the idea behind dollar cost averaging is having a set dollar amount of money that you deploy into your portfolio or an index fund or even a particular stock on a set recurring schedule. Now, like I said, this is most often associated with passive index fund investing. However, you could also apply this to individual stocks. You just want to make sure you're very confident in the stocks that you're investing in on this recurring basis. So let's say now, for example, that someone has $10,000 that they are looking to invest. Well, if they pile all of that money into the market at once, they're not going to have any money left over in case the market goes down. Now, if the market simply goes up from here, that's really not going to be an issue. And that's a lot of what we saw over the last few years. However, I don't think that is likely to be the case tomorrow in the markets based on all of this volatility that we're currently seeing. Unless you have perfect timing in the market, which usually comes down to luck. If you're dumping tons of money into the market all at once, you're eventually going to be setting yourself up for a huge drop. Even worse, if you do experience that, you might not have any money left over to buy the dip. So instead, what you might want to consider doing is investing, $250 on a weekly recurring schedule and aiming to invest that full $10,000 over the course of a year versus putting all of that money into the market at once. Then over time, if the asset goes down, you're actually able to purchase more shares on your recurring weekly scheduled buy. And then over time, you end up paying basically the market average for those shares, which means you're not at nearly as much of a risk of being massively down on that position. And overall, this significantly reduces the risk of a huge loss as long as the underlying asset that you're investing in is a solid choice. If you ended up dollar cost averaging into lousy investments, it doesn't matter, it could still end up losing you money. The key here is that you have to combine this with actual investments that are going to make sense. Okay guys, before we get into the next strategy here, I want to thank today's video sponsor, which is Domain Money. This is a brand new investing app that just launched that allows you to trade both stocks and cryptocurrencies in the same place. In addition, they have a team of investment managers developing proprietary market strategies to take advantage of opportunities in the crypto and stock market. So you don't have to go at it alone, you can lean on the shoulders of experts. They also have a proprietary signal product that allows you to get expert ratings, social media sentiment, key financial metrics, and relevant news at your fingertips. As far as security goes, they have bank-grade security and encryption, as well as next-generation passwordless authentication. Lastly, if you have any questions about the app in general, they have a team of experts standing by to answer your questions. All you have to do right within the app is click on the chat button, and then you're able to connect with somebody and ask questions right within the app. So be sure to check out Domain Money via the sponsored link down in the description below to learn more. So strategy number 2 here on the list is to avoid unprofitable companies. Now, it's sort of interesting because over the last few years, a lot of these unprofitable growth stocks have been some of the top performers of the market. And this is, of course, because many of these are the most innovative companies out there. However, we now know that the Federal Reserve plans on increasing interest rates multiple times in 2022. And this is going to have a direct impact on companies being able to borrow money in the future, essentially making it more expensive for them to borrow money. So an unprofitable company pretty much has two options when it comes to continuing operations. Number one, they can become profitable, which is a lot easier said than done. Or number two, they need to raise or borrow more money. Well, here's the problem. Higher interest rates means higher cost of borrowing, which could push profitability further and further out into the future for a given company. There's also some companies out there that may never be profitable that are only supported by this ultra low interest rate environment. Now, this was similar to what we saw during the dot-com bubble when there was a small group of winners, but there was a lot of companies that were trading at really high valuations that had no chance of ever really succeeding or becoming profitable. So with inflation at a 40-year high now, this has caused a mass exodus from many of these unprofitable growth stocks. And this is because the Federal Reserve has to hike rates in order to try to curb this inflation. Now, that being said, there might be some incredible deals to be had currently in the market. However, it is very risky territory right now for investors. There's a lot of falling knives out there, which means that you go out there and you grab that stock or you grab that knife and it keeps on falling and it ends up cutting your hand and you get hurt at the end. That is a falling knife. That's what's going on across a lot of these growth stocks. So even though they might appear to be fantastic deals, you should definitely, be patient and don't, again, dump all of your money into any stocks right now because of all of the uncertainty and things going on in the market. So how do you determine if a company is profitable? Well, one of the easiest ways to determine if a publicly traded company is turning a profit is looking at the EPS, or earnings per share. So if that figure is negative, that means they are not profitable and they are actually losing money every single quarter in order to continue operations. So for example's sake here, let's look at DraftKings stock. So as of January 13th, 2022, the stock had gone from a 52-week high of 74.38 down to 24.24, which is a massive drop of around 67%. And again, this is one of those stocks that people got really excited about early on, but then when, things got a little bit concerning here with inflation, the stock just sold off tremendously. And if you look into the earnings per share, you get an idea of why this is. So as of their most recent earnings report for quarter 3 of 2022, DraftKings reported a negative earnings per share of $1.35. That means that for every share of the company that exists, so if you were a shareholder, for every share that you own and for every share out there, DraftKings in that very short 3-month period lost $1.35 per share. And if that doesn't seem like a big number, well, this one should right here. In the first 3 quarters alone of 2021, DraftKings has lost about $1.19 billion. That's over 1,000 million, just to put that into perspective. Now, sure, DraftKings might do big things in the future, but for the time being, they're nowhere near profitable, and they're a stock that nobody wants in their portfolio at this point in time. So coming in at number 3 here, guys, the third strategy is simply to go long. Now, I'm going to give you 2 solid reasons why going long is probably a good idea in most cases. First of all, in the short term, all companies are going to have ups and downs, but the good ones are going to do well over the long term, which could mean multiple years, if not multiple decades. If you talk to someone like Warren Buffett, he often says his favorite term for holding on to a stock is going to be forever. So not only does that allow the cream to rise to the top over the long term, second of all, there's also a significant tax benefit often associated with going long on your investments. Now, I just did a full video on stock market taxes explaining exactly that. If you want to check it out, I'll put a card up in the corner. But in a nutshell, you basically have both short and long-term capital gains from the stock market. If you end up selling a stock for a profit that you've owned for 1 year or less, it's going to be a short-term capital gain, which is going to be the same tax rate as the income from your job. However, this is where things get interesting. If you hold on to stocks for longer than a year, even if it's just 366 days, you now have a long-term capital gain if you sell for a profit. And what's crazy is depending on what tax bracket you are in, this could be the difference between paying taxes on your gains and not paying any taxes at all. Be sure to check out those IRS tax tables yourself. It's going to be different based on whether you're, single or filing jointly and your level of income. But across the board, everybody pays less taxes on long-term capital gains versus short-term capital gains. And again, as long as you are making sound investments going in and doing your research, maybe looking at profitability and different factors like that, so long as you make decent investing decisions, going long is going to be a winning strategy in most cases. Now, of course, if you make the wrong choices and you buy, companies that you don't fully understand, or maybe you have no idea they're unprofitable, well, going long could mean that, they end up going nowhere. So once again, this strategy only works well if you conduct thorough research at the beginning and make good decisions. So there you have it, guys. Those are my top 3 investing strategies for 2022. And you could even couple all of these strategies together pretty easily if you wanted to. So that would essentially mean going long on profitable companies following dollar cost averaging. And if you don't want to own individual stocks, you can simply invest in index funds and own huge diversified baskets of stocks. Following these strategies here could keep you out of a lot of trouble to be had in the market over the next year or so, especially as I believe this volatility is going to become the new normal. However, keep in mind, these strategies are only going to work well if you make good investments after conducting your own thorough research. If you want to take some of that guesswork out of the equation, You could invest with an app like Domain Money that allows you to lean on the shoulders of experts and follow their market strategies. So be sure to check out Domain Money via the sponsored link down in the description below to learn more. Thank you guys so much for tuning into the video. I hope you enjoyed it. If you made it to the very end, be sure to drop a like, hit that bell for future notifications, and make sure you're subscribed as well. And as always, I hope to see you in the next video.